Good morning. David Stewart, Straight Talk Wealth Management. My Monday musings for the 28th of February 2022. I want to talk about market timing rather than timing the market, or market timing versus timing the market, and whether or not it's the right time, bearing in mind where we are and the current volatility, to take advantage of your annual ISA allowance. It's a well-proven concept, which is that market timing is almost impossible. If you think about all of the unexpected events that have happened in the last few years, or indeed the last few months, trying to time your entry into the market was almost impossible. Of course, timing your entry into the market is quite different to being in the market. In other words, if you're in the market, you will get the advantages of growth, but of course you will have the possibility of seeing downturns as well. As you know, the time is running out to take advantage of this year's 20,000 ISA allowance that we all have. And of course, this allowance is a use it or lose it one. On the other hand, is this going to be the right time to go into the market, bearing in mind the current turmoil? Thinking about what I've written above, where the market timing is almost impossible, how can it be that I'm suggesting that you should consider investing in an ISA at this time? There's a process that we know as phased investment. What this means is that you invest into a stocks and shares ISA, but make the initial investment into a cash fund. Over an agreed period of time, normally 3 or 6 months, your cash fund gradually feeds investment into a portfolio of equity and bond funds. By doing this, you can take advantage of what we call pound cost averaging. Sounds very complicated, but it's actually quite simple to arrange, and we would of course do this for you. The idea is, if you invest the same amount of money over several periods, for example every month, as the market fluctuates, you will buy more units or shares in a fund when it goes down, and the value of these cheaper units or shares will then rise in line with the marketplace. If you go onto our website, you'll see the chart I've done to demonstrate this on today's musings. But in simple terms, suppose in period one, and period one could be a month, it could be a year, it doesn't matter, it's just a period. If you invest £10 and the value of each unit or share is £1, you'll buy 10 units. If in period two you invest the same £10, but the value of the units has dropped to 50p, so your first period's investment's halved in value. If they were 50p, you would then buy 20 units. In period three, same £10 goes in, the value of the units has fallen to 25p, so you'll buy 40. And then in period four, goes back to 50p, you've invested the same £10, so you get 20 units. And finally, in period five, you invest £10 again. All of the units are then worth £1, so you buy 10. The end result of this is that your total investment is £50. All of the units or shares you purchased are worth £1, so the value of your investment at that point is £100. Clearly, this is a very dramatic example, but what it demonstrates is even with no market growth, you've doubled your money. Again, let me stress, this is an exaggerated example to make the point. So, if you're considering whether or not you should take up your ISA allowance, do get in touch, and one of our qualified advisors will be pleased to assist you. As I say, if you want to see the chart about pound cost averaging, please go onto our website, straighttalkfinancial.co.uk, or give us a ring, and we'll be delighted to talk to you. So this is David Stewart from Straight Talk Wealth Management saying have a good week. See you next week.